Warner Bros. Discovery reported lower sales and earnings in the fourth quarter, underscoring the challenges the media giant faces as it weighs competing takeover bids. So for more on all of this, we're going to bring in Doug Creutz, senior media and entertainment analyst with TD Cowen. It's good to have you join us. Thanks so much.
Thank you.
So looking at Warner Bros., it reported a wider than expected loss of 10 cents a share versus the 3 cents that most analysts were expecting. What do you think drove this miss to start?
Well, most people look at EBITDA when they're looking at Warner Brothers. There's a lot of kind of below the line items associated with the original Warner Discovery transaction that are complicated and not that interesting. And EBITDA was fine. I think the business performed largely as expected. Advertising was a little bit better at the linear networks. There's been some improvement in trends there. The studio, while it didn't have any movies in the quarter, earned a nice amount of money off its other content. And HBO continues to grow and see profitable success. I would also say that commentary for 26 was reasonably constructive. Largely what we expected, although we had been worried that the studio might be looking at tough comps in 26 because they had a very, very strong film slate through most of 25. But they had said they expect earnings of the studio to be roughly flat. So, I think that the print was pretty good.
Okay, pretty good. Lower sales, though, lower profit. Like, is this maybe this is a one-off then in your eyes, or do you think this shows a deeper issue for the company moving forward?
Well, like I say, they didn't release any movies in Q4. That's sort of an anomaly. It's very rare that they have a whole quarter go by where they don't release any films. They'd had a very strong film slate for the first 3 quarters of the year. They also lost the NBA from their linear nets. So there was a lot of advertising revenue that was associated with that went away. But there were a lot of costs associated with that went away too. And we all knew this was going to happen. It wasn't a big surprise.
Mm-hmm. How do you think maybe the bidding war is influencing the stock at all? Or is this more about the earnings that came out today?
Yeah, I think the stock is entirely being driven by the auction that's going on. I mean, the stock was at $11, $12 before Paramount first showed an interest. And, obviously now we're up in the high 20s. Paramount, I think, ultimately will be the victor in the auction. While Netflix maybe would like to have Warner's assets, I think Paramount probably feels like they need to have them and need generally Trump's want. So I do think that Paramount, whether it's the current $31 bid or something a little higher, will walk away being the victor. Now, just because that happens, there's still a whole regulatory process that has to get cleared. And I think that's why the stock isn't trading all the way up to the $31 bid, because there's some chance regulators step in and stop the deal.
So do you think that investors, if they're looking at Warner Brothers right now, should they be looking more at what's happening with these bids on Warner Brothers compared to what's happening with earnings reports?
Yeah, I mean, if a deal unwinds for whatever reason, regulatory or otherwise, then Warner has to go back to being its own company and running its own business. And at that point, the fundamentals start to matter again. I think if you're in the stock right now, you're in it, though, for the bid and not for the fundamentals.
Mm-hmm. And I know you said you think Paramount is going to come out on top on this. What do you think is better for Warner Brothers as a company and for those who are maybe already invested? Is there a better outcome, Paramount or Netflix?
I think it'll either be Paramount or Netflix will walk away with a bid, whether it's 31 or it is the current bid, or 32 or 33. I don't think there's an outcome where Warner stock gets anywhere close to the low 30s without a bidder. So this is definitely the best outcome that investors can hope for.
And better, sorry, I should have clarified too. Is this better than Warner being an independent company?
Well, for shareholders, probably yes. For the rest of us, I'm not so sure. I think having a diversified media industry is a good thing, and having it all rolled up into a few companies is probably not as good, but that's probably a bit above my pay grade.
Okay, Doug Creutz, senior media and entertainment analyst with TD Cowen. Appreciate your time. Thanks so much for joining us.